Ever wondered if that spare change app, Acorns, could actually be your secret weapon for those immediate financial goals? You know, the ones that are just around the corner, maybe a new car down payment, a dream vacation next year, or even building up that emergency fund that's been nagging at you. For years, Acorns has carved out a unique niche in the investment world, primarily known for its roundup feature, where it automatically invests your spare change from everyday purchases. It's brilliant in its simplicity, making investing accessible even for those who think they have no money to spare. And let's be honest, the idea of painlessly growing your wealth just by buying your morning coffee is incredibly appealing. But here's the million-dollar question we're tackling today. Is Acorns genuinely a good fit for short-term savings? To answer that, we need to peel back the layers of what Acorns truly is and how it operates, and then critically compare that against the fundamental principles of short-term savings. Because while investing and saving often get thrown around interchangeably, they're distinct financial strategies with different time horizons, risk profiles, and most importantly, different ideal tools. Let's start with understanding Acorns itself. At its core, Acorns is a micro-investing platform. It takes your money, whether it's roundups, recurring investments, or lump sums, and invests it into diversified portfolios of exchange-traded funds, ETFs. These portfolios are built by experts and range from conservative to aggressive, designed to align with your risk tolerance and financial goals. The beauty of ETFs is that they offer instant diversification across various asset classes like stocks and bonds, without you having to pick individual securities. This approach is fantastic for long-term wealth building, as it smooths out market volatility and allows your investments to benefit from compounding returns over extended periods. However, the key phrase here is long-term. Acorns is an investment platform. And by definition, investing carries inherent market risk. The value of your investments can go up, and it can go down. While historical trends show that the stock market tends to trend upwards over the long haul, short-term fluctuations are not just common, they're guaranteed. We're talking about daily, weekly, and monthly volatility that can significantly impact the value of your portfolio. Now, let's pivot to short-term savings. What does short-term actually mean in this context? Generally, financial experts define short-term as any goal you want to achieve within 1 to 5 years. And what are the defining characteristics of money earmarked for short-term goals? They are safety and capital preservation. The absolute priority is that the money you put in is the money you get out, plus any modest returns. You cannot afford to lose a significant portion of your principal. Liquidity. You need to be able to access your funds quickly and easily when the time comes. No lengthy redemption periods or penalties for early withdrawal. Predictability. You need a high degree of certainty about how much money you'll have at your target date. Wild fluctuations in value defeat the purpose. When we hold Acorns up against these criteria for short-term savings, a few critical discrepancies emerge. 1. Market volatility, the elephant in the room. Imagine you're saving for a down payment on a house, and you plan to buy in 18 months. You've diligently been sending your roundups and regular contributions to Acorns, watching your portfolio grow. Then, 6 months before your target, the market experiences a significant downturn. What was once a healthy sum for your down payment could suddenly be worth 10%, 20%, or even more, less than it was just a few weeks prior. This isn't a hypothetical fear, it's a very real possibility when your money is exposed to the stock market. For short-term goals, this level of uncertainty is simply unacceptable. You can't gamble with money you absolutely need by a specific date. 2. Fees, a silent erosion of short-term gains. Acorns, like most financial services, charges fees. For basic accounts, these are typically a few dollars per month. While these fees might seem negligible when viewed against the potential long-term growth of a substantial investment portfolio, they can significantly eat into the modest returns generated by small, short-term savings. If you're only saving a few hundred or a few $1,000s for a short-term goal, a $1 or $3 monthly fee can represent a substantial percentage of your annual gains, effectively negating any positive returns and potentially even leading to a net loss. When you're aiming for capital preservation and modest growth, every penny counts. Traditional savings accounts or high-yield savings accounts, while offering lower interest rates, often have no monthly fees, making them more cost-effective for short-term horizons. 3. Investment horizon mismatch, the core conflict. Acorns, by its very design, is built for long-term investing. The power of compounding, the ability to ride out market dips, and the growth potential of a diversified portfolio all shine over years, even decades. Trying to force this long-term tool into a short-term savings box is like using a hammer to screw in a light bulb. It's the wrong tool for the job. The risk profile of an investment platform is inherently misaligned with the safety and predictability required for short-term goals. So, if Acorns isn't ideal for short-term savings, what are the better alternatives? For those crucial short-term goals, the focus should always be on safety, liquidity, and predictability. Here are the workhorses of short-term savings. High-yield savings accounts, HYSAs. These are perhaps the single best option for short-term savings. Offered by online banks and some traditional institutions, HYSAs provide significantly higher interest rates than traditional savings accounts, often 10 to 20 times more. Your money is FDIC insured, up to $250,000 per depositor per bank, meaning it's incredibly safe. They are highly liquid, allowing you to access your funds easily and quickly without penalties. And critically, their value doesn't fluctuate with the stock market. While interest rates can change, your principal is always secure. Money market accounts, MMAs. Similar to HYSAs, MMAs offer competitive interest rates and FDIC insurance. They often come with check writing privileges and debit cards, making them slightly more accessible than pure savings accounts, though sometimes with a slightly lower interest rate or higher minimum balance requirement. They offer the same level of safety and liquidity that's essential for short-term goals. Certificates of deposit, CDs, for money you know you won't need for a specific period, e.g., 6 months, 1 year, 2 years. CDs can offer slightly higher interest rates than HYSAs. The trade-off is that your money is locked in for the CD's term, and withdrawing it early typically incurs a penalty. This makes them less liquid than HYSAs or MMAs, so they are best suited for very specific short-term goals where you are absolutely certain of the timeline. A CD laddering strategy, where you stagger the maturity dates of multiple CDs, can offer a good balance of higher rates and staggered liquidity. With that said, thanks for watching, and until next time.